Tens of billions have been wiped off the value of global markets, driven by renewed fears for the major economies on both sides of the Atlantic. With the US debt deal done, attention has returned to the state of the US economy, and the data doesn't look good. It doesn't look good in Europe either, where there is concern at the apparent unravelling of the latest European bailout. Italy and Spain are being pulled closer to the edge. Borrowing costs for both are approaching the levels that saw Greece, Ireland and Portugal fall into the arms of the Rescue Fund. We'll hear from London shortly, but first this report from Sue Lannon.
It was a day of reckoning for Wall Street. The debt deal may have passed in Washington, but now investors are worried about the US economy on the back of more disappointing economic data.
I think the main driver of what's happened in the last few days is sort of recognition that maybe, these sort of protracted negotiations over the last few months have had more of a damaging impact on confidence than people probably realised at first. Interestingly, some of the interesting stuff that's come through is that growth for the past few quarters has been revised downwards.
Further fears too about Europe's debts, this time in Italy, where officials held an emergency meeting. That sparked a rout on global markets. Wall Street lost most of its gains this year. European markets followed suit and are down again this morning. And the Australian market dropped to the lowest level in nearly a year. The benchmark index, the ASX 200, is comprised of Australia's biggest companies. It's already down around 9% this year as economic gloom and debt crises dampen investor confidence. Some are predicting a bear market, a prolonged period of falling prices.
So yes, we're heading towards bear market territory, and if the macro news globally continues to disappoint, then it's a bear market that I think will continue right into next year.
And an even bleaker outlook.
The risk of recession next year is around 30%.
Others are not so pessimistic about the likelihood of a bear market here or globally.
Well, at Barclays, we don't actually believe so. We believe the US economy in Europe will muddle through and Asia will remain strong.
BlackRock's James Holt says the jury is still out on a double-dip recession, but Europe remains the key concern.
The greater risk, I think, would probably be, if anything did happen, would be in Europe, where Europe has played a game of extend and pretend, extend the loan terms to countries like Greece, pretend that they're okay.
Adding to the domestic gloom, retail trade figures show consumers just don't want to spend. Sales dropped slightly in June, down for the second month in a row. But the Federal Treasurer is talking down the US and Europe, but talking up Australia.
We do have some soft spots in the economy, but we shouldn't lose sight of the fact that unemployment is low, that public debt is low, and that we have a huge investment pipeline, and we are bringing our budget back to surplus in 2012-13.
The International Monetary Fund still sees inflationary pressures from the mining boom.
The recovery remains on track, and we see very, very strong investment intentions in the mining sector, taking investment to near 50-year highs for the private sector, that I think there will be likely a need to raise interest rates a little bit to contain the inflation pressures.
Others predict a rate cut is more likely. Short-term money markets have factored in a rate cut in coming months.